Well, happy Friday, everybody. Colin Harper, certified financial planner, along with Michael Kutch, our chartered financial analyst and our portfolio manager here in-house. First off, thanks so much for joining us and taking some time out of your Friday to figure out what's going on in the markets. And our topic, our planning topic for the week is kind of the basics of Medicare. But before we get rolling in, I've got a little picture to share with everybody. And it is, so funny story. I'm actually at my daughter Gabby's grandparents' house this afternoon here. Our nephew's getting baptized this week, and I am in my my father-in-law's office here that he graciously let me use. And for those of you just listening in, if I get run over by a reindeer, am I covered by Part A or Part B? Well, we'll answer that along with some other questions about Medicare basics later on. But Mike, I think the market's getting run over by a reindeer right now. I know we don't have any real positive economic news to share with anybody. You know, we're kind of looking at, sorry, I removed the mic, not the screen share. We were looking at kind of the economic data. We're looking at inflation that isn't trending the way we want it to. We've had some CPI reports since we last got together. And then, a couple of other things we've been looking at. Mike, you want to hop into the market side of things? One important note to remember, nothing we say today should be used as specific recommendations to your situation. These are just our thoughts and observations on the market. If you want to know how this affects you on a personal level, we'd be happy to have a conversation with you or reach out to your trusted financial professional. And with that said, Mike, I think that reindeer's picking up steam. And let's talk about a lot of the negative things we've seen going on this past week in the news on the economic front.
Yeah. So I'll start with some of the economic data and then kind of get into the overall market level. So like you said, we got the inflation numbers this week, which were a big disappointment to the market. So the headline number came in higher than expected for the month, but still trended lower on an annualized pace from the July reading. So it came in at 8.3% year over year. So last month was 8.5. The month before was 9.1. So the headline number is at least trending lower, but not as much as we would hope for. The core CPI was a bigger disappointment. So this number is the one that excludes food and energy, which are those more volatile areas. So it increased 0.6% for the month and annualized at 6.3%. So that's the highest annualized reading we've gotten since March. So that's why the market's kind of having a bit of a panic this week.
Yeah, and that's not a comfortable spot to be in. I know, cars, especially recently, my wife and I were looking to buy a new car and a lot of other people. And not only do you have to wait 6 months for the dealership to deliver them, but those markups are ridiculous. So we're seeing a lot of that there as well.
Yeah, so used car prices came down a little bit, but not as much as last month. We also saw some declines in airfares. And gasoline obviously was the biggest contributor there. On the other side, what's kind of keeping inflation elevated, food continues to go up. That sticky rent component is going to continue going up for probably the next 6 months because that lags housing quite a bit. Utilities are rising, service prices. So overall, it was a pretty broad increase, minus that gasoline and other two areas. So shifting into retail sales for August, it increased 0.3%. But if you take out the auto sector, we're looking at a decline of negative 0.3%. So we're seeing some weakness there. Also, some detractors were gasoline, e-commerce, and then health and service prices. So this could potentially lead to a lower GDP for quarter three. And I think we've started to see some revisions in the past 24 hours or so. So go ahead.
No, I was going to say if my wife's Amazon account does not agree with that decrease in sales.
I don't know if mine does either.
But yeah, definitely some not strong numbers on that front. Sorry, Mike, go right ahead.
Yeah, so kind of shifting more to the corporate side of things, we saw a couple companies come out with pre-announcements. This morning we saw a pre-announcement from the biggest transportation company. I won't mention specific names, but you know who delivers things besides Amazon. And then we also got one from a major metal company last week. So this could just lead to more and more revisions in the coming week and could put downward pressure on the earning estimates for quarter three and the next few quarters. So that's something we talked a lot about last week. Shifting to where we are in the market. So Tuesday, we saw the biggest one-day price decline in about 2 years on that CPI report. I think the S&P was down 4.3%. The NASDAQ was down 5%. And then today's level, we're seeing another down day, and we are below that 3,900 level on the S&P, which I discussed as being a possibility last week. So if we hold that level today, it's my thinking that we're probably going to get down to the previous lows of the year, which is about 5% lower from here. So what changed on that CPI report? The futures market, the Fed funds future market's now anticipating the terminal rate, that's kind of the rate they get up to before stopping, is going to be 4.25%. That's kind of where I've been thinking that we really need to get to. So whether we hold that low if we get there, it's really going to depend on that terminal rate, if it needs to go higher than that to get inflation down, and how much earnings need to come down. So opinions vary quite a bit on the terminal rate. Some very well-known and respected portfolio managers believe that they've already gone too far. And then on the flip side of that, you have that whole other camp that says they need to go beyond 5%. That kind of matches up historically with the data that says you have to get the Fed funds rate above the core inflation rate to have that level roll over. But we'll just have to see how, hopefully we start seeing more and more indication that is rolling over. I think some of the commodity prices take a little longer to roll into that than, say, gasoline. But we're still in that seasonally weak period of September. So come October, middle to end of October, I think it could turn out to be a really attractive buying opportunity.
That some great insight, Mike. At one point, as I was driving over to Cincinnati for my nephew's baptism, I drove right by Kings Island, and I got to kind of get a glimpse of some of the roller coasters over that way at that amusement park. And if you've ever listened to Dave Ramsey, he's got a saying that the only people that get hurt on the roller coaster are the ones that jump off. Right? We've been on a pretty good roller coaster right now, and obviously for everybody, it doesn't make sense to hold every position long term. But for the most part, if we look at the historical data behind this, there's not great economic news out there. I think things are still going to get worse. But for folks with a long time horizon, often the best course of action is to kind of stay the course and enjoy the roller coaster. Enjoy is probably a pretty strong word. Kind of live with the roller coaster a bit longer. So for long-term investors, this isn't necessarily a huge issue. We understand the market goes in cycles, but I think we're getting pretty close to a fairly attractive entry point here. Would you agree with that, Mike?
Yeah, absolutely. And even looking at the current level we're at now from a price to earnings standpoint, and just based on where we currently are economically, it's not a bad entry point, but you might get a better one in coming weeks.
Yeah, and I think that's something we're keeping a close eye on for our clients and inside of our portfolios. But for folks out there who aren't working with us, we'd be happy to have a conversation. But I think we're definitely getting pretty close there. And also, at the end of the day, we come on here and we talk about what the markets are doing and what we're doing for the folks we work with. But the real question is how it affects you, the listener out there, and how these moves in the market are going to affect your long-term goals and plans. And that's what we try to do in our practice, right? We take a whole bunch of data, a lot of which that Mike is very familiar with, that blows right over my head too sometimes. So we take all that data and all that knowledge of history and apply it to specific situations. And I think that's kind of the best use of this data for our purposes is what does it really mean for you as the consumer? It's been an uncomfortable year to say the least. And I think we're certainly not anywhere. We're not closer to the end of that than we may have been, last month. There's definitely some downward trend still left to happen is what we're seeing out there, but not every sunflower grows straight to the sky, right? So, there are going to be speed bumps along the way, and we build this into planning on the planning side of things. So is there anything positive we have to look forward to from an economic front before we get together next week? I know the answer is why I'm kind of smiling, but anything positive we have to look forward to as far as the markets go, Mike?
Only if you like hearing Jerome Powell talk. So he'll be speaking after the Fed meeting on Wednesday. But besides that, it's a little gloomy, but there's certain areas that really haven't been that effective. Housing's been disastrous, but the employees still very strong. That whole situation's good. The manufacturing numbers are still hanging in there. So things aren't collapsing. And the lower we go, the better the level is to get into the market. And to go off your point of being a longer term investor, it's very difficult to time the market. Like, you shouldn't ever try to get 100% in or 100% out. Making gradual moves where you take risk off the table when things are getting elevated and add some exposure when asset levels are depressed makes sense. But certainly don't go all in and all out. It just not a strategy that is successful historically. What do they say? It's not about timing the market, it's about time in the market.
I think that's very true, right? And there's a lot of data on that. If we kind of look historically, the 10 best days in the market are within the 10 worst days of the market historically. So staying invested for the long term, making smaller tactical decisions is what we've done for a long time. And I think what makes sense for most folks. It's very much not an all or nothing strategy. And the moves we're talking about in our end are not all or nothing. So I think that's a fantastic point, Mike. Awesome. Well, thanks for the update. We'll obviously keep a close eye on this and get you guys some more information next week. And on to kind of our planning topic of the week, Medicare. And Grandma is still out there wondering whether she's covered by Part A or Part B if she gets hit by a reindeer. So let's answer that question and a couple more about Medicare. This is by no means meant to be a comprehensive take on Medicare. It gets complicated quickly, but we'll start very simply and try to simplify what I like to call the alphabet soup of Medicare, right? So you got A, B, C, and D. And what are those different programs? How do they talk to each other? So Part A is hospital coverage. So if you are in a hospital stay, your Part A of Medicare will kick in. Part B is medical coverage. So think of you go to see your primary care physician, Part B kicks in. Now here's where we kind of differ, right? Part C is Medicare Advantage. So you have the option to pick Original Medicare, which is Part A and B, or Part C, which is on the private marketplace, and that combines Part A and B into one wrapper. Now, there are definitely pros and cons to each of them, but to sum it up very, very simply, your Original Medicare A and B is generally a bit more expensive than those Medicare Advantage plans. You can find any washed up NFL quarterback promoting, especially as we get closer to open enrollment here that starts on October 15th, you'll find a bunch of, washed up NFL quarterbacks kind of promoting different Medicare Advantage plans. You can get a lot of those at lower cost than your original Medicare A and B. One of the downsides, though, is with Medicare A and B, you can go to any physician or doctor or specialist that accepts Medicare, which is, a very, very large number of providers. When you start switching over to the Advantage plans, your access to doctors gets a little more limited. So it's important to select if you have doctors on your list and you want to make sure you still see those doctors and you decide to go the Advantage route, it's important to select a plan that would cover your doctors. And then the last one, Part D, is the prescription drug coverage. And that's a very, personal decision as well, based on what prescriptions you are taking. So I would definitely encourage you to explore the options there between Medicare Advantage and then Original Medicare. We don't sell Advantage plans in office, but we can certainly be used as a resource to kind of steer you in the right direction. We get a ton of questions about that. One of the biggest ones that come up that I want to make sure I mention is there's a lot of folks who turn 65, but they're still working. And we've run into this, plenty of times you need to make sure you raise your hand for Medicare when you turn 65. You don't necessarily have to, sign up, but you need to make sure you raise your hand. And what I mean by that is you've got to, at least sign up for Part A. And the reason for that is even if you're covered through your employer, if you don't sign up for Part A and you miss that window when you hit 65, there's a chance that they could recoup some costs later on because you made an error and didn't remember to file. And if you're in that situation, there's a bit of a gray area there. We'd be happy to talk through that with you. So is grandma covered by Part A or B? Well, if grandma goes to the hospital, that's Part A that's going to kick in for her. If she's got to go see her primary care physician for some follow-up, that's Part B that's going to kick in there. But really the biggest takeaways are it's a very personal decision, like a lot of financial planning topics. Make sure you talk to somebody you trust. And if you have questions, we can certainly talk in generalities about it and steer you in the right direction as far as Medicare goes. And then, kind of just to sum up the differences between original and Medicare Advantage. Advantage is going to be a bit cheaper. It may limit your access to, physicians and doctors that you like. If you know you're going to travel all over the country in your retirement, original may be a better bet because you're going to have coverage a lot more places than an Advantage plan would. If you're more of a homebody and you're not going to leave a 20-mile radius, then maybe an Advantage plan makes more sense. So just a couple quick considerations and basics about what does Part A, B, C, and D mean. Next week, we'll get back into the markets a little bit more. Like always, if there are specific topics you guys would like to hear about, we would love to hear them. Just throw a comment down below. We'd be happy to chat about those. Mike, any closing thoughts on the day? Anything you want to leave everybody with on this Friday?
Nope, that's it on my end. Everyone have a great weekend.
Awesome. I'm going to go. My nephew's getting baptized this weekend. I'm the godfather. I've been threatening my wife all week. I'm going to wear a t-shirt I bought off Amazon that says man, myth, legend, godfather to mass. So if you don't see me next week, it's because I did and my wife murdered me.
Well, good luck with that.
Thanks. But I hope you all have a fantastic Friday. We look forward to catching you next week. Take care, everybody.
Okay.